Buying or selling, 5 concepts you must know. Contingent notes, fixed notes, down payments, guarantees, and bogeys. They are all super important and are baked into almost every acquisition or transitional deal. Hey, welcome once again to The Rare Advisor. Today we're going to talk about a fistful of items that are important to you in the world of M&A as it relates to you and your practice. Whether you're buying, whether you're selling, whether you want to acquire, whether you want to merge, whether you have a succession plan in place, whether or not you want to transition to a younger generation, whatever the case might be, these 5 items are going to be very important for you to understand in terms of how deals are created. Now keep in mind, every deal is unique. Every deal is different in terms of how they get assembled, but there's some terminology that can make things a little more understandable that you'll want to look out for. Now, some of this is my own personal interpretation of how these deals get put together. Everybody has a different way of coming, a different angle or a different way of coming at these things, but I want to talk to you today about contingent notes, fixed notes, down payments, guarantees, and bogeys. So think about that really quickly. It's a mouthful. Contingent notes, fixed notes, down payments, guarantees, and bogeys. They all fit together, pieces of a legal puzzle as you deal with any sort of a transition, acquisition, merger, or sale. So with that being said, let's jump right in. Contingent notes. Contingent notes are almost exclusively used on emergency deals. So if you have an emergency succession plan, whereas if something was to unexpectedly happen to you and you want to protect your own value in that business for your family, for your estate, also you want to keep the practice running on behalf of and for the benefit of your clients, then you should have an emergency contingency plan in place. Those almost always work on a contingent note basis. So what that means is the payouts are going to be contingent on the transactional revenue that's taking place. So they represent a percentage of the payout going up to the agreed amount price or the agreed amount structure of the deal or a period of time, whichever comes first. So contingent notes again, also can be married together with fixed notes. We'll get to that in a moment. But a contingent note also generally happens on any transactional revenue or commissionable revenue, non-recurring revenue. So normally there's going to be a contingent note in place. So let's just say you have a large block of fixed index annuity business. That business was commissioned. It was front-end loaded, that you've already received the revenue on that. Regardless of surrender charges disappearing and all that, you know, in the old days, there was people who would try to roll that business over and so on. That's just not how the world works anymore. So the value of that business doesn't carry near the weight as does recurring revenue. So assets under management, things of that sort, kind of obvious. You probably already know that, but nonetheless, it's a very important distinction. So when we're working with this stuff, the transactional revenue is going to pay out on a percentage. So let's say it's a 5-year payout, just to keep the math really easy. Then you're going to see that transactional revenue coming in, 20% of it would get paid towards the deal over the next 5 years. And then what would normally happen is you've probably agreed upon a price in the beginning, at least as it represents that section of transactional revenue. And I keep saying that because keep in mind, you can do a contingency arrangement over the entire practice. You can do, and that's what normally happens on emergency deals. We'll come back to that in a minute. Or you can do a contingency deal just on the transactional revenue and keep the recurring revenue separately on a fixed note. So we'll come to that as in the near future here in a minute as well. So now let's go back to transactional. If you're paying it out at 20% per year on that transactional revenue being generated, and you have a number in mind, let's say you hit that number 4 years in, then that last year is off the tables because you've already been paid 100% of your number based on the volume of business that the 20% accumulated to a full payment, and you just got that full payment ahead of schedule. Let's say that you had the exact same amount as you expected, and that 20% comes in like clockwork each year, and you hit it right on the nose in 5 years. Perfect. Everything ended exactly as expected. But now let's assume the opposite happens. Let's say that 20% paid out each year on all their transactional revenue does not, at the end of 5 years, add up to 100% of what was the original selling price. Most deals at that point in time would then end. So there was a shortfall, if you will, because the transactional revenue did not live up to what was anticipated. So now let's talk about an emergency deal. Same thing, but normally a contingency arrangement would not always, but oftentimes would apply to the entire practice now, including the fee revenue. And a lot of times that is because when a practice is sold under duress, under an emergency, because something has happened to the previous owner, then there is always a much higher risk because you didn't get to strategize over a 12 or 18-month period how you were going to hand the baton off to the next buyer to maximize the values for both parties. It's something that has to kind of be swooped in on, acted upon very quickly. It's always smart if you announce this in advance to your clients so they know that there's an emergency plan in place. You've most likely been asked before, hey, as a client, what happens to me if something happens to you, the advisor, first? You can explain that you have this emergency plan in place, this contingency plan in place, and whoever that's with, an outside entity, internal next generation advisors, a large institution, the financial practice on the other side of town, whatever the case might be, but you now have an answer. That's important because if something does happen to you and the emergency contingency plan gets triggered, this is what's going to buy you time. The fact that your customers know that this is expected. So we'll talk deeper about that on a different discussion if you'd like. But for now, I just want you to understand how the contingent note, not to be confused with a contingency plan, how the contingent note is contingent on ongoing revenue, paid out at a percentage, whether it's the full practice on an emergency deal or the subset of the practice, the transactional revenue on a normal deal. So that is a contingency note. Now let's talk about a fixed note. Normally your fixed note is going to likely be tied to the recurring revenue sources. So assets under management, 12B1 fees, anything that is recurring revenue that's going to happen and going to throw off value in the future. So you've got an asset today, the clients, the business, and so on, that is throwing this recurring revenue off automatically. That most likely would be a candidate for a fixed note. And because of that, because of that very stable revenue, you can anticipate much easier what a fixed note structure would look like. And a fixed note is just what you would think, like a mortgage on your house or whatever the case might be. And you're paying those payments just like you would normally do in any sort of other debt-oriented arrangement to pay off that asset, to buy that asset over time. Now, that's a lot more structured, a lot more traditional, if you will. But keep in mind, there still might be a number in there. So if you're hitting that fixed note, if there's any kind of flexibility in there, then you still might have this targeted number on the back end. Sometimes you see that, sometimes you don't. But then more importantly, oftentimes there's what's called a bogey. Now, the bogey is a whole nother discussion. So we'll go to that next. A bogey generally is a way to identify the calibration taking place on a fixed note. So it kicks into play, protects, depending on which side of the deal you are, protects the buyer from significant fall off in what they're acquiring. So let's just say the bogey is 90%. On a 90% bogey, if you were on $1 million deal, so let's just say the transaction is worth $1 million, that the purchasing of this financial practice worth $1 million, and there's a 90% bogey on that. What that means is that if 90% or more of quote, however you want to define the business stays intact, then you will receive 100% of your payment. So if 90% or more stays intact, you will receive 100% of the payment, or you will be due to pay out 100% of the payment. Again, depends on whether you're the buyer or the seller. However, if you fall below that, then things are going to change. Now, when I said, how do you define the practice? You can define the practice by the actual revenue. You could define the practice by the volume of assets. You could define the practice by the headcount of the clients or the number of households, or a combination thereof. Now, why would you do that? Well, because of market performance and things of that sort. So maybe if 100% of the assets stay in place, all the clients stay in place, you're the seller, so it worked out exactly the way it was supposed to, but we have a financial crisis and the market crashes, and therefore the revenue goes down. Maybe you negotiate that that's not your problem. On the other hand, maybe if you're the buyer, you do want to have that in the deal. Or maybe there's some sort of an averaging technique that you're going to use amongst multiple benchmarks of how to identify or define what the overall practice represents, so that you can come into a formulaic approach that then crafts this bogey that we're talking about. But either way, you're needing to stay above the bogey to get 100% of the payment. So now what happens if you fall below the bogey? If you fall below the bogey, generally speaking, the remainder of the deal, or the payouts, or the payments being made, would ratchet down on a prorated basis. So let's say, for example, the bogey is still at 90%, but you come in at 85% of the business, the assets, the revenue, what we were just talking about. Then now that would say that in the next, let's say 12 months, depending on how the deal is structured, that the payment will now take place at 85%. So as soon as you break through that bogey, now it's prorated. Above the bogey, you receive a full 100%. That's at least how they normally are structured. So bogeys are really important, and you want to negotiate, depending on which side of the table you're sitting on, you want to either negotiate that bogey higher or negotiate that bogey lower. Either way, the good news is it's in everyone's best interest to get 100% of the business to stay on the books, because now as the seller, you get the most bang for your buck in terms of the asset you've created, and as a buyer, you've kept, in terms of what you were purchasing, 100% of the business you wanted to buy. So those all obviously connect very closely together. Then you have guarantees. The guarantee usually refers, at least the way I've seen it being used, usually refers to the first year's payments on the fixed note. Because remember, with the bogey, you don't really always know what the second year payments are going to look like, but you can guarantee the first 12 months. So oftentimes what you'll do is you'll have a down payment, which is what you would think it would be, but it normally probably only applies on the fixed note, not on the contingent note, because the contingent note is more of a crapshoot, because that's business that's already been paid on. There's no revenue stream there anymore. So you get a down payment on the fixed note plus a contingency note on top of that fixed note. And then that down payment is part of that first year guarantee, I guess you could say. So because you're getting the down payment up front, then you're getting a guaranteed income stream on the fixed note for the first 12 months, plus the variable income stream on the contingent note for the first 12 months. So that first year guarantee would be your down payment plus your first 12 months payment on the fixed note before any calculation related to a bogey. And then beyond that, now you're dealing with a bogey on your fixed note, and you continue to deal with any fluctuation on your contingent note. It's a lot to digest. We actually have a 15-page report, the Advisor Blue Book report. If you have not gotten a copy of that and you'd like one, reach out to USA Financial, ask for any one of our business development consultants. They would be happy to get that in your hands and walk through that with you in greater detail. But again, 5 important parts of a deal: contingent notes, fixed notes, down payments, guarantees, and bogeys. Hope that makes some sense, clear as mud, right? It's a lot to digest. I highly encourage that you get the Advisor Blue Book report. So hope this was worth your time. Please give me a like, give me a thumbs up, and please subscribe to The Rare Advisor. Be back again to talk to you soon. Thanks.